Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I'm going to go over a couple of presentations I made. This was back in 2021 for the channel. I'm just going to kind of reiterate what my viewpoints are, how I invest. I'm an investor, I'm not a trader. So I see a lot of people in the comment section, they're saying, oh, I'm down on something. Oh, I'm this. Guys, that's normal. Normal market fluctuations go up and down. What I do is I notice structural problems in the market where it takes 5 to 10 years to fix. And I'm not trading in and out of stocks. I'm taking positions, big positions, and then riding these positions for 5 to 10 years. And I call them, they're structural in nature. They're not event-driven or news-driven events. Which may only last a month or a week or 2 weeks. A war it could be longer in its duration, but that's still an event. It's not structural. Structural is demographic driven. It's investment or underinvestment driven. It's usually interest rate driven, something on the lines of that could last for a long period of time. So I'm going to go over some of the events that are happening and have happened in past and how I would be investing for them. So this is called structural versus events. And we'll dive in here and I'll talk about, I made this in 2021 and I gave this presentation on the channel, but I'm going to kind of string a couple of these together so everybody knows kind of where my viewpoint is. The difference between structural versus events. Structural is the underlying fundamentals of a move. They're usually rooted in demographics or underinvestment or a cycle, a longer term cycle, which is structural by nature. It means that you can't really knock it off of its, when it gets into a trend, you can't knock it off trend unless you put investments or something in it to fix the underlying problem. It usually takes many years for that to happen. Events are shorter in duration. They can happen inside structural moves that can create opportunities. Events are something like a war. They usually are not, they may last a year or two. An event is a recession that can happen inside of a structural problem in the markets. So you can have a problem in the market like we have a housing shortage. Interest rates could go up, but interest rates doesn't solve the market imbalance of supply and demand. All it does is delay it. It delays it through affordability. So structural means that you've got a demographic that is out of whack. Usually you have increasing interest rates, and those interest rates increase until the supply demand is satisfied. And then it will head back around. But I still think that we have structural problems in energy, and it's not event-driven. It is a structural problem. The war in Russia, between Russia and Ukraine, is an event, but that isn't the problem. That didn't start the structural problem in energy. Underinvestment did for many years in this ESG movement, which will not solve our problems, in my opinion. So I invest for the structural move, and events can create better buying opportunities, but will be short-lived. I think we are going through some events, potentially a recession, that will create buying opportunities in a structural problem in energy, in a structural problem in commodities, and that will be a buying opportunity. I don't know if oil has a solution. We could be hitting peak oil worldwide over the next few years, where we hit the pumping capacity of the world, and we will never be able to exceed that pumping capacity again. That could be life-changing and completely life-altering in terms of investments as we bump up against our energy output for oil. And I think that energy is probably the spot to be in the next decade, by far. And I don't think going to mineral-intensive solutions is necessarily going to be a solution, which is renewables. I think that eventually, when people figure out that we have an energy problem, which is structural by nature, it's not event-driven, it's not because of the Russia-Ukraine war, It is because of underinvestment, potentially, and maybe not. Maybe it is a natural force of peak oil that is coming over the next few years or 5 years or whatever it is. If that is the case, I think that everyone's going to turn and run to a low mineral intensity, high energy returning source, which would be nuclear. The only problem with that is I don't think we can go to electric vehicles because we would have to have this gigantic mining boom. And I don't think a mining boom of that size could potentially happen with an energy crisis simultaneously happening. So there's some weird things that could potentially happen there, and I don't think electric vehicles are a solution at all. After kind of looking into it and thinking about it, they just take too many minerals. We'd have to absolutely explode our mining many fold for that to happen, and I just don't see that happening in any short period of time. We can't do a 10x or 15x on some of these minerals. I just don't see it happening. Just period. So I think hybrids will probably win out. I think platinum will be an incredible investment and all these other things because it's structural. And I don't think people are looking at it from that perspective. So this is long-term interest rates dated back to 1790. And what I think is coming is what's in the red boxes, an increasing interest rate environment. If we have an energy crisis where we can't fix it and it's structural by nature, every time we've had that type of scenario, we've had higher interest rates, usually paired with a larger demographic. But here's the problem. If we can't fix the oil problem, if we are hitting peak oil and we can't increase our energy consumption, I think that will result in higher interest rates and failed currencies. And again, guys, I'm not trying to tell you when this will necessarily happen, but watch the energy markets, watch oil. And most of these time frames, we've had larger demographics and we had an oil problem in the 1970s, and that's when interest rates really took off. But this was demographic driven in all these events. And we do have a demographic driven event, but oil, I think, is going to have some serious problems. So there's some very good opportunities for investment there. And if you guys want to know which investments I'm partaking in, definitely subscribe to my website in the description link below, Platinum membership, if you want to know exactly how I'm playing all this. This is 100 years of commodity valuations. Again, we are very low in relationship to the Dow Jones Industrial Average here, which means that from a ratio perspective, we are very cheap in commodities. This is structural by nature. Underinvestment led to this problem. And I don't think we have the mines or the areas identified in the world to fix this problem. And I don't think some of these companies are going to actually be able to mine it. They're going to nationalize their stuff, and things are going to. I think the world's going to change going forward. It's going to be a paradigm shift. It's not going to be like this world of plentiful commodities. We might start to see scarcity over the next 20, 30 years. This is just the platinum price and those boxes of commodity booms. I think we're entering another boom. Yes, this is pulled back some, but I do think that we're going to see a boom in a lot of these commodities. I have SM Energy here, basically the support resistance line or level, support, and then underneath would have been a good buying opportunity, and here we've come up above it. At that time, it was at $18 when I created this. But this was the huge buying opportunity that I saw. And structurally, just kind of coming back, we have a commodities bull market, potentially higher interest rate environment coming our way. This was before interest rates went up. This was back in May of 2021. May 24th, 2021 is when I posted this. We have a bull market in real estate that is going to kick off all of this. And an event could disrupt the housing market and delay the move a little, like COVID did, but it won't stop the move. I don't think it'll necessarily stop the move, but they can slow the move down, which is what interest rates are. Now, I've got another presentation here that I want to go over, news versus structural again. Kind of go over this. News-based movements. News-based movements can last for a few days or even up to a week or more, maybe a month, depends what it is. They are only short-lived blips and can be used to accumulate more shares if it was a move to the downside. This recession fear that's in the market is a news-based movement, or even if it is a true recession, will only last most likely in months, or at the longest, maybe a year or two at most. But they're usually short-lived. They're only short-lived blips and can be used to accumulate more shares. Sometimes can last longer if news is used multiple times in a row. Eventually, the stock will end up reverting back to the underlying market conditions for the company, for the sector, for the commodity, for whatever it is. We have problems and imbalances in the energy market. A recession could obviously slow it down, delay it, and maybe that's exactly what is needed, and what is causing this recession is energy driven. I don't think they fixed the underlying problem in energy. So we could be bouncing back and forth between energy scarcity, recession, energy scarcity, recession, and we go back and forth and cycle back and forth. The structural changes the environment the stock trades under determines the valuation. Low interest rate environment, low inflation environment, increasing, decreasing interest rates. Stocks love low inflation, lowering interest rates. We are increasing interest rates with higher rates of inflation. That's good for commodities. Valuations relative to other assets, that is a structural change in the markets. Changing market conditions is what we want to look for. And right now, they're changing favorably for commodities given higher interest rates and inflation. Now, could that inflation slow down some? Yes, it could. But I still think it will be elevated. It could be very elevated depending on the energy costs and that relationship to the consumer price index, because high energy costs translate all those costs into the CPI. Earnings release can be both news and structural. Earnings drive stock prices higher, unless you're an electric vehicle company or technology, apparently, because they've just taken off even without earnings. Oftentimes during earnings releases, they give forward guidance on the company, which can be structural. They also give clues to structural changes for the company. And then we've got pullbacks here. Companies can experience large pullbacks while being under a structurally strong environment. It doesn't mean that it's just going to go lower and it's now in a bull market or a bear market. We can be in a bull market, you get pullbacks, and if you're in a bull market and you get a pullback, in my opinion, what I am doing is I'm going to buy the pullback. Gold and silver is experiencing this right now. Same with oil, same with uranium, same with a lot of these different commodities. They could very well go lower a little bit, but I think that we're off our highs by over 30-40%. In a lot of the companies, that's usually about what they pull back, between 30 and 50% in a bull market, and that's usually where you want to buy them. I'm not saying that as advice or anything like that. I'm just saying in general, you buy off the pullbacks in a large structural bull market. Tops have market conditions changing while you see certain sectors expensive and others are cheap. So basically, it's a rotation of money flow eventually. That's what a top or a bottom looks like, depending on which asset category you're looking at. Being in the front of the pack is where you want to be. You're going to have to kind of beat the herd, and you want to cost average out or in over time, depending on which asset you're in and are moving out and in and into. So at tops and bottoms, what you're going to see is you're going to see momentum changes in the stock. You should see volume kick up at the bottoms or the top. You're going to see downtrends and uptrend lines being broken. And no one owns, the sector that's going to be at the bottom. Retail investors are everywhere in the sectors that are at the top. So if you see a lot of retail buyers, retail investors, that is usually where the top is. That's where you don't want to be. You want to be in areas where no one's really buying it or even talking about it. You need to get to the party before everyone else does. So the conclusion here, this channel and what I do is it looks at structural changes in the market when it comes to investments. I look at the dollar, inflation, real estate, valuations, which is ratios, yields, etc. I use news-based movements for potential buying opportunities if it provides us pullbacks. Large pullbacks can occur in a favorable environment, and I usually buy those pullbacks. So I watch the market conditions when this occurs. I make sure everything is still intact structurally. that we still have an energy crisis, that we still have depleting inventories, that we don't have the investment going in there. And that's what I look at, our inventories. Inventories tell us the health of that market or the health of that sector or commodity. And we could see a split in some of these commodities where some commodities are not doing very favorable, and then other ones are doing incredibly favorable. I'm still a huge bull in energy, just flat out, period, because we haven't fixed anything in the energy area. We have declining inventories, and right now, I don't see anything that would make me bearish on the sector yet. Recessions don't necessarily mean lowering demand. So keep that in mind too, because we've only had 10 years over the past 100 years where demand actually fell. Some of them, like in 2020, was where we shut down the economy. So that one was expecting, and that's what created that large buying opportunity. That was a news-based event in a structural bull market of energy where we went to the downside, and our ratios showed us that where it created a buying opportunity. So the shutdown actually created one of the largest buying opportunities of a news-based event in a structural move of commodities and energy. So use those news-based events to gain greater positions in commodities, because commodities they're underinvested, not just from investors, but they don't have enough investment going into the mines. I don't know if you can even have enough investment. A lot of these mines are in really bad locations, and I think they're going to probably kick the mining companies out. They're starting to do that. And they're also starting to tax coal companies and other energy companies with gigantic taxes. Australia is doing it. It's possible that America starts to tax large oil companies differently and shipping companies. So even if you do get it right, and if we get into this large shortage in commodities and energy, they might try to tax everything just ridiculous amounts. So, keep that in the back of your head. How are you going to play this? Maybe physical metals is a good spot to be, to get your money out of the system and away from these governments that just want to tax all these mining companies and natural resources. So just something to keep in mind. That's all. But again, structural move is how I invest. News-based movements within it, or short-term. Recession is short-term, in my opinion. And people get very afraid. There's no reason to be afraid. Ball that up, throw it in the garbage. That's all emotional driven. Tell me that the structural, that the energy crisis isn't structural, and tell me what we've done to fix it. We haven't done anything. We've just delayed it, releasing strategic petroleum reserve releases. And if all of the solutions are grounded in mineral intensity things, commodities, I think will do well, because if we're going to solve this energy crisis, which I don't think renewables will, I think we're really going to have to, I don't know how they're going to solve this. This is going to be a tough solution. I think we're going to have to invest more in producing more oil. Unfortunately, I don't think there's anything that can replace it. That's my take on it. And I'm going to stay long in things that are proven, known energy, good energy return on investment, good energy returns given mineral intensity. I'm going to stay long all that stuff. So that is my strategy at this time. I also like the precious metals because I think we could get into currency problems as well out there in the future. So remember, I'm playing the long term here. I'm not playing, am I up this week, next month? I'm looking at this from a decade-long, 2-decade-long perspective and how to position for the big moves that are coming. And there's also ways that I might play it where I can sidestep some of these taxes. The companies themselves can, just based off of where they're located sector-wise. Because some of these mines, I think, are going to be sitting ducks. Anyway, that's what I've got for today, guys. If you like the content, give me a thumbs up. Check out my channel, or on my website, I should say. In the description link below, the website's there. You're going to have to sign up. It's a pay-for membership. Platinum membership's the one that I'm going to do. We'll have a question and answer session coming soon. I'll have to get the timing down there for everybody. That's to be determined yet, and I'll get that up here shortly. But that's all I've got for today, guys. Obviously, thanks for listening on this, and we'll catch you next time. This is Finding Value.